Hey everyone, I'm back to do another video on Composer.trade. This is the platform that I've been using for a couple of years, and I find it really one of the most innovative that I've seen in quite some time. The reason being is that rather than uh, placing a trade for one stock selectively, you can actually put baskets of stocks together that are traded automatically, algorithmically, so that you don't actually have to tend to it on a daily basis, which can save a lot of time and frustration. The Another benefit is that when you kind of just leave it alone, it might do better than you could do by yourself. So sometimes that's a good thing. Let's talk about this symphony. It's called AI Train, and what I've done is brought together some tech names, AI related names, as well as some other symbols that when the market's dipping, it'll help to soften the ups and downs of this symphony. So when the S&P 500 or SPY is above the 200-day moving average of SPY, then we're going to go select the top four names that have performed the best over the last 10 days. Okay. So when the market's rip roaring and it's doing well, you'll get into some of these higher volatility names: Amazon, Google, Meta, Nvidia. Um, and because they tend to move the most, they will be selected when the market's moving. However, when the market's dropping, these names will drop fairly quickly, right, by percentage terms, which means that this will automatically move into names gold, the U.S. dollar, bonds, and oil, for instance. So you'll see, like today, I'm going to run this, say, over the last 6 months. Run that. Okay. So if we go down here and look at uh, the names that this is invested in, you could see one of them is oil, and then we've got Bitcoin, which is a ETF, MicroStrategy, and Tesla. So mostly we're in high volatility. However, we have oil, which is buffering it a little bit. Okay, so that's going to help when the market's falling. You'll get into these uh, uh, lower volatility names. So what does that mean for you in your trading? Well, if we look at the return here, uh, the S&P 500 gained 8.8% over the last 6 months and had a drawdown. That means from the time you entered the trade to the time you left the trade, how far did it fall during that period, right? 6.7%. So then we look at this symphony. You can see it's more than 6 times the performance with a higher drawdown, but look at the return you're getting. All right, so it's always good to keep an eye on this because the drawdown is probably your biggest metric to look at for the possible risk that you might have in this trade. Okay, I think I'm going to go through and talk about the what happens when this is not above the 200-day moving average. If that is not above, that means all these are all out, and then we go into a combination of gold and the U.S. dollar. These tend to do well when the market is falling, and so um, this is this happens automatically every day. We're looking they're each time that we trade, which is around a little before the market close, the composer will assess where everything's at, and then they'll move in and out of these names. So down here, you could see each day there are sometimes the same names and sometimes entirely different names are entered into each day. And so this can this over time, obviously, this makes a huge difference. Let me show you why. Okay, so every day, if you trade, you get an annualized return on this of 155%. What if I wanted to trade this instead of just on based on a percentage threshold on calendar? Okay, so if I choose daily, it's going to be about the same. Let's see, 159%, a few more points there. But I generally like to just default to threshold. This will be 90+% of the time you'd probably use this. But just to show you what the difference daily trading makes, I'm going to go select weekly, which means this will only look for these settings once a week and place a trade. So you can see if I change it to weekly, this drops hugely. Let's look at what it looks like down here. So compare this. You have 8.8% versus 13.3, and look at the drawdown. You get a huge drawdown when you have to wait a week in between trades. All right. So keep in mind that you want to generally set this to threshold. Okay. On that. Um, okay, so that's basically that one. I wanted to give you a quick run through of that. We'll do some more of this in the weeks to come.